All right, aloha everybody. Happy Friday. Thank you guys so
Aloha!
much for joining us. We got Richard here today, Tiffany and Troy. We're super excited to get started in our investor series, Aloha Friday. And for those of you that do not know me, I am Catherine Chong and I'm with Coldwell Banker Pacific Properties. And
Hey guys, Renee Christine Cam, Coldwell Banker. We are here, Aloha Friday Real Estate Talk. Thanks for joining us live, Richard. And for those of you tuning in, we're so glad that you are here as well. So, aloha where you live. Catherine and I came together and we wanted to bring valuable information to our community, and specifically we started this website. Our community website is called AlohaWhereYouLive.com. And in the beginning of the year, we started highlighting businesses with the goal of connecting our businesses to our community and just telling what and why they do in a fun and fresh way. And then COVID happened. And so, we were like, okay, how can we stay connected to our community and bring valuable information? Because that's ultimately our goal. And thus, here, Aloha Friday Real Estate Talk. So we started with market updates and making sure people knew what was going on in the real estate market, how COVID had been affecting the Hawaii real estate market in particular. And then we decided, you know what, we are going to bring this investor series, and it's been proven such a great talk, a real estate talk, because if there's anything that people want information on is how to build wealth. And so that's our topic here today, how to build wealth through real estate. And so that is what we are here. So with that, let me introduce our experts here. We got Tiffany Davies from IPX. Yay, she's super awesome, rock star there. And then Troy Wada.
woohoo!
Troy Wada. He is the principal wealth advisor at Impact Wealth Solutions. And so, Troy, thanks for joining us in our first, never, but first of many real estate talks. But Troy has some really great information. So that's him. Because you're going to get a lot of info in just a little bit. But really, as far as why we're here, real quick, I think what we want to talk about today is if you currently own rental property, right? Maybe maybe you've been infected by COVID, maybe not, but maybe you have. But we're going to bring some solutions, out-of-box solutions that people have not heard about. Particularly, Troy's going to talk about the DST, it's a Delaware Statutory Trust, how you can use that to maybe increase cash flow. Of course, Tiffany's going to share with you how you can use the 1031 to save on capital gains taxes, right? And so, yeah, that's what we're here to do, talk about those solutions. So let's get started.
All right.
Catherine's going to share the screen.
Oh,
Catherine,
no,
no, I'm going to
the
share the screen. Yep. Okay, so here I go. Oh, shucks. I have to start from the beginning. Sorry, guys. We forgot to reset this. So let me just kind of go back. Can you see that?
Yes, okay. We can see.
All right. Perfect. So we're back at square one. So let's take this to presentation mode and let's get started. So real quick, market updates. Just kind of want to give you folks an idea of what's happening in the Hawaii real estate market. So real quickly, these are the snapshots for June. So overall, there are the market is a little bit down year over year, but in comparison to May, we actually saw an uptick. The median sales for a single family home is down to 770,000. That's about 3.8%, I believe. Condo prices, median sale for condo price is down to 421,500. So closed sales down for the month of June, but overall, it's actually up from May. So year over year, we are down, but if you just take a look at that snapshot of May, from May to June, we're actually up, and I'll show you a little bit on the next slide. The median days, okay, median days of the market are there. Okay, real quick, guys. So in comparison, there's your snapshot. So months of inventory, kind of what I want to highlight there, 2.5 of single family homes. So it's super low inventory. And Kat's going to talk about this being a good time to sell if you are thinking about selling. And then the condo sales on the bottom, there's 4.1 months of inventory. So at balance market is 6 months. So that means we're still in the seller's market. There are still some really great opportunities to sell. So go ahead, Kat. Take it away.
All right, thank you. So yeah, with those stats that Renee showed, I think right now the biggest challenge for buyers in today's market is actually just the inventory. So simply, there's just more buyers that are actively looking to buy a home than there are people that want to actually sell their homes. So the favor is in sellers, and it's a seller's market at this point. And according to the existing home sales report, now this is from NAR, which is the National Association of Realtors, the housing inventory nationally is down 18.8% from a year ago. And then houses that are actually coming on the market are selling really fast and very quickly. And so let's talk about the why, right? Why is this happening? And why is the inventory so low at this point? So there's a few reasons why it's hard sometimes today, especially, with COVID, but, there is some, stemming from undersupply of newly built constructed homes. And of course, again, the current health pandemic that we're in. So sellers are actually hesitating to sell due to right now of COVID-19, as we see that across the board. But one of the key factors that is making it a little bit more challenging is that homeowners are actually, on average, are staying in their homes a lot longer. There has been a shift that started about 10 years ago, and people were just staying put longer, which is contributing right now to the lack of inventory. And I want to show you on the next slide a real quick visual. So as you can see here, the norm used to be between 5 to 7 years until the housing bubble burst. So since 2010, a lot of people have just been lengthening their staying time so that they can recoup their equity. So luckily, with the strength, though, of the market that it has gained over the past 10 years, if you're an investor or a homeowner today, you are in a much better equity position, which can give you more opportunity. And so that's what we're going to talk about today. So bottom line, there's just, not enough houses for sale. And, pandemic is leaving a lot of the investors having to pay their mortgages. And that's why we have the amazing dream team here today. They're going to talk about how you can get out of some of those challenges and utilize other vehicles to help you out. So Tiffany, thank you so much for being here. We appreciate you so much. So take it away.
Yes, thank you guys. I'm Tiffany Davies from IPX 1031. We're local here. I live on Oahu, live and work here, and I work for the largest exchange company nationwide. So I really enjoy what I do, which is just really teaching investors about the 1031 exchange, the last great wealth building tool available to investors. Let's just jump right into my information. And what is a 1031 exchange? 1031 exchanges have been around since 1921. It used to be, I like your property, you like my property, let's deed swap. And then in the late 80s, they introduced the delayed exchange timelines, which gave people more time to get a 1031 done. So that's where we saw the introduction of the 45 days, 180 days. You have 45 days to identify replacement property, 180 days to close. But I always like to point out the difference between a primary residence and an investment property, right? Because on our primary residence, we don't do exchanges. You get something called the 121 homeowners exclusion, which states that if you've lived there for 2 years and don't claim another primary, you can exclude gain up to $250,000 if you're single or $500,000 if you're married. And on our investment properties, we have something called the 1031 exchange, which states that if you've owned a home for at least a year and a day or more, and you've claimed that income on your taxes and you've rented it out for a period of time, obviously you don't rent out vacant land, but something that can be rented, it's held for business or income purposes, then you have tax deferral treatment through the 1031 exchange. And let's go ahead and go to the next slide. So I always like to point out, there's a lot of people think it's all about the taxes, and we do 1031 exchanges obviously to defer tax. So swap until you drop, right? We keep selling one, buying bigger and better properties. But there's other reasons that people do 1031 exchanges. It might be to diversify their real estate portfolio, to consolidate their real estate portfolio. So maybe they want to sell a lot of smaller assets and buy one larger asset that's easier to manage. Exchange into property that's closer to home. So sometimes people make the move out to Hawaii and then they have their income properties all over, maybe one in California, one in Florida, one in Texas, and they sell those and they bring them here so they can see, touch, and feel them. Exchange into property with better cash flows. That's the DST, which I'm really excited that we have Troy with us today, because this is basically a backup plan. So, you've got 45 days to identify replacement property, but if you have the DST listed on there, you're never going to fail on your exchange. If you're a qualified investor, this is a great opportunity for you. And, just in my experience, I've been doing exchanges probably for the last 15 years, in the real estate industry for 20. And I can tell you that, I saw a lot of investors that were doing DSTs. And when they had the ability to come back into regular real estate, I saw them going back into DSTs. So I had to make a mental note to myself to really understand what this is and to understand why investors love it. And so I'm going to let Troy share with you more on that today. But buy property with a new amortization schedule, and then my favorite, purchase property to obtain a new depreciation schedule. So the IRS allows you to depreciate property, residential property 27.5 years, commercial property 39 years. After you've owned investment property for that amount of time, you're no longer getting the little credit or every year. So that credit, you get that for a certain amount of time after you've run through that period of time on one property. Sometimes people sell a property and buy up so that they can buy a new depreciation schedule. So let me give you an example. You sell a property for $300,000 in California, okay? You've fully depreciated it. You've owned it for 27.5 years. Now you sell that property, buy a new property here in Hawaii for $1 million, and now you've got $700,000 of new depreciation that you get to take. So sometimes people do exchanges just for the new depreciation that they'll gain. Okay, let's go on to the next screen. So one of the big misconceptions in 1031 exchange is lifetime property. And everybody gets this a little confused. If I'm selling vacant land, do I need to buy vacant land? No. If I'm selling a single family residential property, do I need to only buy another single family residence? No. So it's very broad and general. You can sell vacant land and buy a single family home. You can sell a single family home and buy vacant land. You can sell vacant land, buy commercial, sell commercial, buy industrial. So it's real estate for real estate. And again, very broad and general. As long as you're disposing of real estate and only buying real estate, it's going to qualify. Okay. Time frames in the 1031 exchange. When do these time frames kick in? So of course, we have the process of we're selling an investment property. We open up escrow. We get the exchange paperwork in place before closing occurs. Then closing happens. The day we close escrow, the next day is considered day one. Okay, that clock starts ticking. We've got 45 days to identify what we want to purchase, and we've got 180 days to close. So after 45 days hit, we've got an additional 135 days to close. So in total, it's 180. 45 days is part of the 180. There are no exceptions, no extensions to the time frames unless it's a federally declared disaster. We saw that with COVID. People got a little extra time, which doesn't happen every day. So that was a big win, but unfortunately we didn't feel like it went far enough. We didn't feel like people got enough time. But I really feel, just a quick update on my end, you're gonna see those numbers going up next month. My phone has been ringing off the hook. I think it's coming back, so great time to sell, good time to buy as well, right? All right. So methods of identifying replacement property. 3-property rule, very basic. We send out at closing a very generic piece of paper. It's got 3 lines and a signature spot. You can identify 3 properties, any value. You just need to close on 1 and use up all the exchange funds, right? That's the 3-property rule. And like I said, you can identify the DST as number 3. That way, if property 1 and 2 go away, you've got that DST that you know you can fall back on. The 200% rule, you can identify more than 3 properties. Maybe you can identify 4 or 5, but we don't see it used here in Hawaii too much because our values are so high. So what this rule says is that if I sell for $1 million, we double that number to 2 million. I can supply a list with as many properties as I want, but when you add up all the values, they cannot exceed $2 million. So it doesn't work so well here, but it works great if you're selling $1 million property in Hawaii and maybe going to a place like Florida or Texas where the values are a little lower. The 95% rule, that's kind of a fallback. And what that says is that you must purchase 95% of the value of all properties identified. We don't see that used a whole lot. Usually people are using the 3-property rule. Okay. Reasons investors exchange: to defer the taxes. Okay, so what taxes? Everybody knows about the federal capital gains tax rate, right? Somewhere between 18, 20, 22%. The state capital gains tax rate at 7.25. State withholding, that's called HARPA, that's 7.25. It's a withholding, not a tax, but it does get withheld if you are a non-resident of Hawaii, meaning that you have your primary residence maybe in California and you're disposing of property here in Hawaii. You are going to have a withholding if you don't do an exchange. And you can't do an exchange on a single family, or I'm sorry, on a primary residence or something that is like a second home. You can't do it on that. But in an exchange, you can get around the withholding. So in a 1031 exchange, there is no withholding. And depreciation recapture, we call this the hidden tax. So I'm going to give you a great example. You can go ahead and go into that right now of depreciation recapture and what that looks like. But here's a great example based on a $500,000 sale. Very common, right? We see that all the time. It's hard to find property here for $500,000 anymore. But 15% federal rate. So this is based on I'm just going to pay my tax. Okay, so $500,000 is our sales price. We get to minus off the $100,000, which is our basis in the property. That's hard money cash that we put into that property. So we have a taxable gain of $400,000. At the 15% rate, that's $60,000 just to the feds. That's on the lower end. So when we're talking about the 15% or the 20%, this is your income tax. You're going to pay at the higher end of that if you're a high income earner. You're going to be at the lower end of that if you're a lower income earner. So somewhere between 15 to 20% based on your income. So at the 20% federal rate, we're looking at $80,000. Then we add on that 7.25 to the state of Hawaii. That's an additional $29,000. And then depreciation recapture. So we call this, like I said, the hidden tax. Nobody knows about this until they actually sit down with their CPA and they talk about they're going to do an exchange, and then they figure all the numbers and they see that they're actually generating another $10,000 just on depreciation. So if you look at, you remember I said you get to depreciate a property for 27.5 years up to on residential. So these people depreciated this property for 10 years. They got a credit back for 10 years of $3,700 for owning that investment property. So if you add that up over 10 years, that's $37,000. And then the IRS comes back and recaps 25% of that. So this sale of $500,000 is generating a tax bill of $118,000 at the high end. So when people say, Tiffany, what am I going to pay in taxes if I just pay my tax and don't do an exchange? We say somewhere between upwards of 25%, which is a lot of money. And I can tell you my clients don't want to pay that. And sometimes people get bad advice. not to do an exchange when they actually can. And of course, your CPA is the best person to put their stamp of approval on whether you should be doing an exchange or not. But if you look at that's 100, if you just get bad advice and just say, don't mess with that exchange, that's too difficult. You've got to fight those windows, and it might put you as a red flag to the IRS. That's not true. But this is $118,000 you're parting with, which is purchasing power, right? In a new property. That's money that you can leave to your heirs and, for yourself, for your future, basically. So, it's really in your best interest to look at this 1031 exchange, to understand how it works, and to utilize it to build wealth for you and your family. So that's my section of the exchange, and we're going to jump into DST, which I'm really excited about.
Thank you, Tiffany, for sharing that. And then Renee, if you can, there we go. Perfect. Yeah.
Hey, hi, Alex. Thanks for joining. Stand by, guys.
Hey, guys.
Hey.
Good to see ya. Or hear ya.
So can you guys see my screen okay?
We can, Troy.
Fantastic. Awesome. So thank you guys for joining us today. I'll just run through what a DST is, which very few people have actually heard about.
Oh, Troy, you're muted. You're muted.
Got it. I don't know what happened. It's muted itself. So here we go. So why would someone, want to look at doing a DST, when doing a 1031 exchange? Well, here's 10 reasons why a lot of our clients, after they look at their investment property, might want to entertain the offer of maybe doing a 1031 exchange into a Delaware statutory trust. Number one, DSTs allow the investors to have no management responsibilities. Number two, the investor can get access to institutional quality real estate, limited personal liabilities. The minimums are very small for a DST, $100,000. It allows our investors to diversify their real estate investment portfolio. It's a great estate planning tool. If you heard Tiffany mentioned, we have timelines and hurdles when we do a 1031 exchange, and that's 45 days and 180-day close. The DSTs, because they're readily available, act as a great insurance policy so that those 45 days and 180-day windows doesn't really affect us. And I'll go over some examples of how we can structure a DST to eliminate all the taxes that Tiffany talked about, or what we call boot, but more importantly, allow you to take advantage of the biggest tax benefit of owning real estate, which is basically swapping into your dropping. So bypassing all of those taxes during your lifetime, transferring those assets to your beneficiaries, and getting that step up in cost basis so that they can turn around, go ahead and sell, and avoid all those taxes altogether. So, what is a DST? And how do these 10 benefits apply to this specific investment? The best way I like to say it is that necessity is the mother of invention, and sometimes the first version of something isn't always the best. So before the DST structure evolved, what was common was what we call the tenants in common, or better known as a TIC. A TIC was an entity or an investment vehicle that allowed for up to 35 investors to pool their money together. And the reason why, these people would want to do that is that it allowed them to buy bigger and better real estate. Some of the drawbacks associated with a tenants in common was that every single one of the 35 investors had to qualify for financing. Number two, because everyone had to qualify for financing, they're each liable for the debt. And then because we live in a democratic country, everyone had voting rights and they had to agree unanimously. I don't know about you, but I have clients where their kids have inherited one piece of property. Sometimes it's difficult to get two of the kids to agree what to do with the property, let alone trying to get 35 strangers to agree to something. So, because of that, the IRS, and the industry decided there needed to be something better. And to paint a backdrop, there's a reason why tenants in common only have 35 investors. And that reason is because if it had 36, it would be a registered security and follow all these additional, requirements and restrictions and filings and things like that. And therefore, to avoid all of that, they just kept tenants in common open to 35 investors. So in 2004, the IRS, along with some, industry leaders in the space, decided to create a structure that had a lot of the benefits of a tenants in common with very few of the drawbacks. So the Delaware Statutory Trust was born. The Delaware Statutory Trust allows for up to 500 investors. So obviously this is a registered security, unlike the tenants in common with only 35, which, brings its own benefit, right? Additional regulation, scrutiny, due diligence, whatever you want to call it. All those things apply to this investment. But the other side benefit of having 500 investors is, number one, you can buy bigger and better properties, right? Whereas, we wanted to buy a $35 million property, each investor needed to come with $35 million. Imagine if we want to buy a $300 million investment. Much easier to get those kinds of properties using a DST structure. But because you could imagine, especially in today's loan environment, trying to qualify for financing is very difficult. But let alone trying to qualify 500 people for financing is almost impossible. So therefore, the IRS decided, there needs to be a better way. There can only be one loan put on the property, and that loan is liable by the sponsor company. In this case, it's the company who structured the DST. Therefore, none of the 500 investors are liable for the loan and never have to qualify for it. And therefore, it's considered a non-recourse loan. But as a result of that, the biggest drawback to a DST is that no one has voting rights, right? So you don't really have control. But one of the benefits of that is that sometimes people don't want to have control, and you would not want unsavvy real estate investors to have control because they might make poor decisions at the wrong time. So we touched a little bit about diversification, and when we talk about diversification, we're talking about things like asset class. So a DST can come in many shapes and forms. It can come in the form of a healthcare property, which an example might be a senior living facility in Washington or the radiology department at NYU. Another asset class could be student housing. One of that could be a privatized student housing facility at Central Florida University, or another one could be one at the University of Alabama. Multifamily housing is something that a lot of people are familiar with. But even in that space, those kinds of things vary. One could be a 40-acre community that has 300 single-family townhomes on it. Another one could be a apartment-style building in New Jersey that has 180 rentals. Whatever it might be, it's geared for multifamily type housing. And what's great about the multifamily housing is and same with student housing, we get diversification through rents. So as you can imagine, owning a property that has 300 tenants, it's much more diversified than owning one condo in Kaka'ako, for example. And then lastly, we have blue chip office. These properties could be things like ESPN's U.S. national headquarters, AT&T's headquarters, Zurich Insurance, and another example is actually an Amazon distribution center. Believe it or not, each of these properties actually sit each in their own Delaware Statutory Trust today, managed by the company and created by the company that we'll be talking about very briefly later on in this presentation. But besides the fact of getting, asset class diversification in terms of the types of real estate we can invest in, we can also achieve geographical diversification, and not to put any more I guess, any more concern than is needed. But I am born and raised on the island of Kauai. So as you can imagine, I'm 40 something years old, or you'll know this by figuring this out. I've been through 2 hurricanes in my lifetime. And if you've all seen the movie The Descendants, which is actually a true story of a family on Kauai that pretty much owns half the island. After the second hurricane, which was in 1992, Hurricane Iniki, right? They decided to geographically diversify their real estate on Kauai, sold off some properties, did a 1031 exchange, and actually their proceeds actually sit in a Delaware statutory trust managed by the company that we're going to talk about today.
Wow.
That is one of the benefits of having geographical diversification, is that in Hawaii, are we really diversified by owning property on Kauai, Big Island, and Oahu? Not really. We'd probably be more diversified, spreading our eggs in many baskets by maybe owning a property in Arizona, owning a property in Washington, or, New York. Now, I know one of Tiffany's examples was a lot of reasons why people do 1031 exchanges is because they want to bring the properties closer to home because it's easier to manage. With a DST, we can get geographical diversification without the management. So in all the properties that I told you about, none of the investors are responsible for the terrible T's, as Tiffany and I call it. And the terrible T's is not Tiffany and Troy. Okay, the terrible T's are tenants, toilets, and trash. So it allows our investor to basically have geographical diversification without having to manage all the daily headaches that come along with property management. So what are the basic mechanics, or how does a DST work? As we mentioned, they will be specific based on asset class, which means that you will not have a DST that has a student housing, a healthcare, and a multifamily all in one DST. No, each DST has its own asset class in it, and you can pick and choose which asset class you wanna participate in. Second is that each DST goes through extensive due diligence, because not only is it filed with the SEC, I am a registered investment advisor, and my licenses are hung with what we call a broker-dealer. My broker-dealer will go through extensive due diligence on every single Delaware statutory trust that comes through our door. And actually, we require an independent third-party valuation and appraisal and due diligence study done on every single one of the DSTs. Not only that, once it goes through that BD approval, it comes to my firm, and I have an investment committee at my office, and we look at every single Delaware statutory trust, because just because it was approved by the SEC, just because it was approved by my broker-dealer and Inland's own due diligence, legal, and property management team, does not mean I'm going to recommend it to my clients, right? So it goes through an extensive due diligence process, and the benefit to the client is that many times these properties are acquired 6 to 8 months ago, and the due diligence on those properties was done 8 to 10 months ago, right? So we have the ability to know what we're buying and not feel rushed, because as Tiffany mentioned, we have this 45-day identification period, right? So we can usually make a more educated identification by looking at something like a Delaware statutory trust. Income and appreciation. Why does everyone invest in real estate? Because they want income and appreciation. The same thing applies to a Delaware statutory trust. The target income for most DSTs are about 5% cash on cash return, net of all fees. And another benefit that the Hawaii people like is that the state of Hawaii general excise tax does not apply to the 5% that you get. So you don't need to do this filing every single month anymore. We save money on taxes. But not only that, as you can imagine, real estate usually tends to always appreciate over time, right? That same appreciation applies to the Delaware statutory trust. And when the DST is liquidated, which of course it will be, meaning that it will be sold to another institution like the California pension, like Stanford's endowment, like another real estate investment trust, which could be owned and managed by Blackstone, for example, who owns the Bellagio, who owns MGM Grand in Las Vegas. These properties are bought off, sold to those institutions, and you, the investor, get your principal back along with profits. And that target profit is about 3 to 5% equity growth a year. And that's kind of what we're shooting for. The same benefits, if you remember, Tiffany talked about benefits in terms of taxes when it comes to real estate, and one of that is depreciation. The depreciation will still apply to the Delaware Statutory Trust. It will actually they will actually send you an informational 1099 for you to itemize on your Schedule E, so you can recognize that depreciation, so that not all of that 5% on cash return is actually subject to income tax. And then lastly, we talked about the biggest benefit of all with owning real estate, and which applies to Delaware Statutory Trust too, is that step up in cost basis. The non-recourse loan, allows the investor, being that they never had to qualify for the loan, it allows people who invest in a Delaware Statutory Trust with proper planning to do very creative things. And we're going to cover some of that in some examples that Tiffany and I have worked on together. But for the most part, DSTs usually have, if you're in the healthcare, has a 0% loan to value. Student housing, multifamily has around a 50% loan to value. And blue chip office usually is about an 80% or higher. Now, why do we add loan to values or mortgages on properties? Well, the reason being is because we know that not everyone that sells their property, and Renee, of course, you would attest to this, is debt free, right? Usually people sell their property, they have a mortgage on it, and as Tiffany mentioned earlier, the biggest misconception we face is that when someone sells $1 million property with a $500,000 mortgage, they think they need to go out and buy a $500,000 property and they'll be okay. That's totally wrong. You need to buy a $1 million property, which means that you need to go out and get a $500,000 mortgage, or come out with cash, right, and put an additional $500,000 to the purchase price. But very few people have $500,000 in cash laying around, and very few people, usually, depending on what stage of life they're in, want to go out and apply for another mortgage, especially in today's loan environment, right, where people loans or financing has come through heavy scrutiny because a lot of people are unemployed. They might not qualify for the mortgage. Number two, right, because of historical low interest rates, banks are slammed with refinances, home equity lines, and whatever you can think of, which then makes that 180-day close even harder, right? So the reason why we put loan to values on there is so that when clients sell their property with someone like Renee, and it is that $1 million property with a $500,000 mortgage, they take that $500,000 in equity, put it into a student housing program, buy $1 million in real estate. Tiffany's happy because they met all the requirements, the taxes are zero, right? And the client is happy because they never had to qualify for the mortgage. They're not legally liable for it. And we can usually close the deal in 10 to 15 days for the client. What are some of the risks with a DST? No different than owning traditional real estate. Speaking of hurricanes, natural disaster, of course, that is one that could apply to DSTs. Tenant damage, environmental issues, flood, vacancy, mortgages, if they ever called back the loan, but however, that has never happened in one of the deals. And it doesn't really apply because we have a non-recourse loan. And any other risk that is associated with owning any other investment property still applies to this, okay? But the biggest risk of all is the fact that investors don't have control and no voting rights. But like I said, some investors think that that's a benefit. Now, what is the cost? Many times we have clients that tell us, you know what, this sounds too good to be true. What does it cost me? Well, because you all work with Renee and Catherine, you're on this call today. If you decide to list your property with Renee and Catherine, and they end up doing a great job at selling it for you, and you decide to do a Delaware Statutory Trust, I will rebate 1% of your sales price to your DST account. So what is the cost to you to get in? Nothing. You make 1%, right? What's the cost on the exit? No different than the commission that Renee is going to charge you to sell your property, 6%, right? So the only fee you'll pay is a 6% on the exit. Now, of course, right? In Hawaii, if you own an investment property and you don't manage it, you have someone, a property manager doing it, you know there are property management fees, and these fees still apply to the Delaware Statutory Trust. However, unlike Hawaii, the management fees in most DSTs are about 3% of the rents, okay? However, your 5% cash-on-cash return is net of the 3%, which means that it's not a 3% in addition or after you get paid your 5. You get paid your 5 after they take their 3, okay? So how do we get out of a DST? Well, the goal of every single DST is to be sold, as I mentioned, to another institution or to another real estate investment trust. And the average life cycle is about 7 to 10 years. However, with the company we work with, they have never had a multifamily Delaware Statutory Trust last longer than 5. Okay. The profits on the equity growth is distributed, and whatever is remaining in the reserve fund is distributed amongst all investors proportionately based on your percentage of ownership, right? And when the DST sells, we get approximately, it depends on the DST, but approximately 4 to 6 months in terms of notice, which is good for you, because then what you do is you pick up the phone, we call Renee, we're gonna get Tiffany on the line again. Hey, the DST is selling off. And I remember you telling us we need to swap until we drop. Is now a good time to buy something here locally because we need to do another 1031 exchange. Renee and Catherine are the experts at that. They'll help you find great properties. If it is a great time to buy in Hawaii, we do the 1031 exchange, continue to defer all taxes. If it's not, roll it into another DST, let the cycle go through again. So how do we choose the right Delaware Statutory Trust company? There needs to be certain qualifications or parameters that you should measure a investment company by. Not only does this apply to DST companies, it actually applies to any investment company you work with, whether it's Fidelity, Vanguard. What you should look at are things like asset size, history, track record, expertise. But in this case, we're talking about real estate, quality of real estate properties. We choose to work with Inland. Inland is the largest provider of Delaware Statutory Trusts in the US. They account for about 40% of all of the DST transactions in the US. They're a multi-billion-dollar company. They've been around for 53 years, and they have the most number of successful full cycle DSTs, meaning that they have the most number of successful programs completed that sold off to other institutions and the investor got their money back. Inland has their own bank, legal, property management company, and the quality of real estate that Inland can deliver to the client is basically bar none. They are the second largest landlord of Walmarts in the U.S. The largest landlord of Walmarts is the Walton Family Trust. However, in the 90s, Inland was the largest landlord of Walmarts. Only within recent has Walmart been buying the properties back. AT&T, Verizon, ESPN, NYU, Zurich, and now actually Amazon. All of these properties reside each in their own Delaware Statutory Trust, which is why we like to use Inland. Here's a picture of the 4 owners who still own it today. And now I'm going to wrap up our time talking about some examples of how you can actually benefit from using a Delaware Statutory Trust. So in example number 1, we've had a client that basically had a $6.75 million apartment building that she sold, and she bought in the late 90s for $3 million, and she had $1 million mortgage on it. Now, if you remember, when she went to do because of her exchange, because of the $1 million mortgage, she needed to buy $6.75 million of real estate, but she only had $5.75 million of cash, because the mortgage got paid off at closing, right? Banks are the first to get paid off at closing. So what did she do? She decided she wanted to buy a smaller, newer walk-up apartment building here on Oahu, and she spent $4.5 million in cash and bought this investment property. Now she has $1,250,000 left at IPX, actually, and she had 2 days to figure out what she's going to identify because she's on day 43. Okay. Luckily, she works with a great realtor, kind of like Renee and Catherine over there. And I was in the realtor's office the week prior, and the realtor had her call me. So when I met with her, she said, look, I have 1.25 million and I know I need to buy 2.5 million in real estate, but I don't want to get another mortgage. So what can you do for me so I don't pay any taxes? And basically, if I couldn't do the DST, there's nothing I could really do for her, you know, because she would have to pay those taxes if she didn't get the mortgage. So what did we do? Well, she sold her property, right? She bought that $4.5 million property all cash that was spitting off about $100,000 in income. What I did is I 1031 exchanged the balance, the 1.25 million, into a 50% loan to value Delaware statutory trust. This was actually a multifamily DST in Washington, D.C. 1.25 million in equity at a 50% loan to value gets you 1.25 million in debt. She bought 2.5 million in real estate. Now let's do some basic math. 4.5 million for the apartment building, 2.5 million on the DST. She bought 7 million of real estate. She only needed to buy 6.75. So her taxes was 0. But not only that, the DST actually spits off 62,000 a year in income. When she adds up her income from the apartment building and from her DST, she's actually making more income now, and she is debt-free. She does not have a mortgage that she's liable for. Now she's kind of kicking herself in the butt. She wished she didn't overpay for the $4.5 million apartment building. But because she really, really wanted it, right? And against her realtor's advice, the realtor advised her to offer $4 million for it. She wanted to overpay so that she got it. But she thought, well, what else am I going to buy what other apartment building can I buy for 1.7 million? So let's just give them the 4.5 and get this good one. Whereas she could have bought that for 4 million and put 1.75 in the Delaware Statutory Trust and get way more income, right? So that's an example of how we use the DST to replace the client's debt alongside doing a combo where she found a great property that she wanted here in Hawaii. Now, here's another example of how we use the DST. We had a client that basically inherited a property from her mom. And her mom originally bought it in 1950 for $30,000. Okay. But her mom passed in 2001. But after discussions with my client, I realized that because her mom gave her the property in 1990, when her mom was alive, and her name went on title, she lost the step up in cost basis benefit. So instead, what she got was a carryover cost basis, which meant that her cost basis was $30,000, not the value of $700,000 when her mom passed away. Why is that important? Because the property is worth 1.1 million today. Is it better to pay taxes on the difference between 700,000 and 1.1 million, or 30,000 and 1.1 million? Of course, we wish we got the step up in cost basis, not to mention that she was taking, she was renting the property from 2001. We sold the property in 2018, right? So she was taking 17 years of depreciation. What's her cost basis? Probably 0, right? Probably had no cost basis left. And not to mention, she took out a $200,000 home equity line because she used that home equity line as a down payment on her condo she bought in Kaka'ako. So after we looked at her mortgage payment, after we looked at the cost to maintain the property, because she just spent $10,000 fixing the fence, and she needed to spend another $50,000 to fix the roof, we thought it was a good idea to sell because she's only making $2,400 a year, and she's 71 years old, right? Divide 50,000 by 2,400. That shows you how many years it would take her to break even, right? Or to recoup that cost of the roof. 20-something years, she'll be like 90-something years old. So it made more sense for her to sell to get out of having to renovate and fix this property. But she had that mortgage. She had the $200,000 home equity line that she had to pay back. So what did we do? We advised her to sell the property. She sold the property for 1.1 million. She had 900,000 in equity because the home equity line got paid off first, and she was making 2,400 a year. We took the 900,000 at a 50% loan to value, added 900,000 in debt. She bought 1.8 million in real estate. Tiffany was happy because there was no taxes, right? But not only that, look at her income. Her income went from 2,400 positive a year to 45,000 positive a year, right? Now her comment to me is, Troy, what am I going to do with all my money? And so I tell her, well, you could adopt me, you know, but actually she's one of my clients that comes to my Japan trips with me every year. So I said, we can just take another trip to Japan. What's wrong with that? You know? Now, the last case, which, you know, I think is very creative that we came up with, is that, you know, as Tiffany mentioned, that, you know, you can never touch your equity at closing or come into what we call constructive receipt. Because if you ever took cash out at closing, it's going to be subject to all those taxes that Tiffany talked about, right? Federal, state, capital gains, 3.8 Medicare surtax, depreciation recapture. So I'm not saying Tiffany is a liar, because she is absolutely not. But what I am saying is that we've came up with a way to allow our clients to access the equity in their property and sell it without having to pay any of those taxes. So here's how we did this. We have a client that had a property that he bought from his father or his parents for $100,000 in 1998. Now, of course, it was worth way more than $100,000, but why did he pay $100,000 for it? The parents wanted it to get it out of their estate to do Medicaid planning, right? It's very common here in Hawaii where families go out and they sell their property to their family member at a discounted price, so that if they ever ended up in long-term care or wherever, the facility could not put a lien on it. So what happens? Like in the last case, the cost basis is not the value of what it is at death, it's the 100,000, because that's what he bought it for. Okay. Fast forward, it's worth 2.8 million today. What he wanted to do was take out 400,000 at closing. He thought he was going to pay about 50,000 in tax, right? And how he came up with the number is 20%, right? Which we know is wrong. Okay. And he thought he would buy a place in Las Vegas for 350,000. And the reason why he didn't want to exchange into that place for 350 was he thought that if he bought it at 350, his daughter was going to live there for 5 years when she went to UNLV. In 5 years, the property value might go up. He's going to pay even more taxes, because at the end of that, when she moved out, he wanted to get the cash out of the property and then use that cash to pay off his primary mortgage. His daughter's out of college. He would be debt-free and he would retire, right? And his current investment property, or the current $2.8 million property, is generating $44,000 a year in income. So what did we do? Well, we told him before he listed the property, because he was smart, he contacted the realtor and he said, look, I have this property and this is what I'm thinking. I want to take out $400,000 at closing, pay the tax, and buy my daughter a place to live in Las Vegas, because she's going to go to UNLV next year. Okay. I know I have to pay the taxes, but after doing the taxes, we figured out he, instead of paying $50,000 in tax, it was closer to like $150,000 in tax, right? And he was like, gosh, that sucks, you know? So what we did tell him to do is take out an $800,000 home equity line, right? Now with that $800,000, you go and buy your property in Las Vegas. And actually what he did is he took the balance and he already paid off his primary mortgage. So he's debt-free right now. Okay. We 1031, we listed the property then. The realtor sold the property. We sold it for $2 million, or well, we sold it for 2.8 million, but there's only 2 million in equity because the bank got paid off first. At 800,000 home equity had to get paid. 2 million in equity comes into the Delaware Statutory Trust that had a 50% loan to value. We put 2 million of debt on it. He bought 4 million in the DST, but he gets 100,000 a year in income from the DST, that 5% cash and cash return. So what happened in this case? He was able to buy the property with tax-free dollars in Las Vegas. He was able to pay off his mortgage. Not to mention, he was able to increase his income. Okay, so just a recap. you know, great ways to use the DST. You can eliminate your mortgage, increase your net cap rate or your rental return. It allows you to be more tax efficient, whether you're doing an exchange or for estate planning. More importantly, it allows you to simplify your life. Yeah. And all while avoiding capital gains, depreciation recapture, and the 3.8 Medicare surcharge, or what we call the Obama tax. And with that, I think we might have a couple minutes, maybe. I'll open it up for questions and I'll pass it back to Renee.
So awesome. That was so good.
That was great. Incredible, Troy. Thank you.
So, hey, Richard, do you have any questions for Troy? Just want to make sure we give you an opportunity to ask those questions.
Yep. So you mentioned that most DSTs actually get cycled out after like 5 years. Does that invoke the 6% fee on exit at the 5-year point?
Yes.
Okay. So I guess that's kind of one of the risks, right? You're not in control, as you said, and if they choose to sell it early, you could be hit with the 6% fees more often than you'd expect.
Correct. But usually they're only going to sell when they have a profit.
Right.
Yeah. So it's no different than, but that is true. No different than selling any other investment property, though. You can look at real estate commission.
Oh, yeah. Yeah, it's just, usually when I have my investment properties, it's my decision when to sell.
Absolutely.
Rather than, hey, surprise, we're selling.
Absolutely.
Good question.
Great question.
Richard, any other questions?
Not really. So I think I understand it.
Good.
Yeah, it's a good way of structuring things. I probably classify myself as an accidental investor. I never set out to have investment properties. But what happened is, as things happen in life, well, especially my UK property, I end up moving. I thought I was going to go back to England. I never did.
Oh.
So I have a rental property that I've had for 35 years.
Wow.
But it's in England.
Awesome.
Yeah, it's in England, so it's not subject to all of these 1031 rules and all that sort of stuff.
Right.
Okay.
Which is fun and games. But as I said, I do have 2 rentals in Waikiki.
Oh,
okay.
Great.
Also accidental.
That's great. I want to be accidental.
Yeah, me too. That's a good thing.
Yeah.
Well, we're so glad that you're here to get this information. I think just listening to that again, it's just wow, right? I was listening to Troy, I was listening to you, and then taking more info from Tiffany. I was like, TNT explosion. That was happening for me. TNT explosion. And so we're just, and that's just what we're here to do, is bring the information so you can kind of gather that and make some decisions based on how you want to do your real estate financial goals and wealth building. And so we're so glad you're here, Richard, and any connection that we can make to Tiffany and Troy, that's what Catherine and I want to be, is a resource, your trusted advisor, real estate advisor, and just knowing that we're here to help. And so just thank you, Troy. That was phenomenal. I know Troy and I jumped on a call because, gosh, that scenario 3 totally sounded like the scenario call that we had last week. But literally, instead of paying $125,000 in taxes, somebody wanted to do that. I was like, well, maybe we can, restructure that. And so just great strategies to help anybody think out of the box and save on ultimately giving your money away to taxes, right? They're out there.
Yeah.
So thank you so much. Any last words, y'all?
No, have a great weekend.
Have a great weekend.
Thank you guys so much.
So happy Aloha Friday, everyone. If you ever need anything, just reach out to Catherine or I, and we'd love to answer any of your questions or point you in the right direction or help you sell or make a purchase in real estate.
Thank you.
Okay.
Bye. Bye,
everyone.
Richard. Thank you.
Aloha.
Aloha.